Is the real estate market going to crash? Well, the short answer is no. Based on the numbers, the market will not crash even in a couple of years to come. But many factors will play in favor of a pattern change. While the housing prices exploded during the pandemic, due to a mix of low interest rates and limited availability in desired areas, people bid up the price of homes, lending to an overall increase. This year, 2022, and the next couple of years will be almost the same, especially in the major metropolitan areas. Here are the 5 factors that will impact the housing market in a couple of years to come. 1. The mortgage rates will continue to climb. 2. The sale price growth are expected to slow. 3. Housing affordability will remain a challenge. 4. Normal seasonal buying patterns are likely to return. 5. Desire for shorter commutes again. 1. Mortgage rates are expected to climb. The constant mortgage rate fluctuations may have even the most informed consumers scratching their heads. They may also have you wondering what exactly goes into predicting future rates. Most housing experts point to inflation and the Fed accelerating its asset purchasing tapering as sure signs of higher mortgage rates, ranging in the upper 3% up to upper 4%, and keep rising slowly but surely. 2. Sale price growth expected to slow. Most likely the housing market is expected to stay robust through 2022, with many of the trends that propelled real estate to new heights last year remaining firmly in place this year as well. Last year, homeowners saw a market in which their properties sold quickly and frequently above asking prices, as numerous homebuyers fought for the winning bid. The housing market is coming off a year in which home prices in the United States increased by an unsustainable 18.8%. Will the housing market continue to grow at this rate, or will it be a little less frenetic this year? The housing market is even tighter now than it was prior to the spring 2021 housing frenzy. Even industry titans like Zillow increased their bullishness in January, increasing their projected home price growth rate for 2022 up to 16.4%. 3. Housing affordability remains a challenge. By taking money out of some Americans' paychecks and creating a housing shortage, the coronavirus delivered a blow to housing affordability. However, in a counter-trend that has softened the blow to buyers' budgets, the pandemic drove mortgage rates to record lows. But that mortgage affordability, however welcome, comes with a caveat. Higher home prices are often going to require a larger down payment, which is often the biggest barrier to accessing homeownership, especially for first-time buyers with low or moderate incomes. And most measurements of home affordability are missing that key data point: the ability to make a down payment. While low down payment loans are available for first-time homebuyers, a $50,000 price jump can quickly add thousands of dollars in upfront costs to a home purchase. And first-time buyers with scant down payments can have a harder time winning bidding wars against buyers with more cash on hand. A lot of times, sellers want to go with the sure thing over the person who has to get more through lending. And if the price escalates, and you will have to come up with more of a down payment, but you're already at your limit, you'll get priced out faster than someone who has more savings. Buyers who are able to waive inspection or financing contingency clauses also have an advantage in multiple offer situations. 4. Normal seasonal buying patterns are likely to return. Over the past few years, homebuyer journeys have felt more like a marathon of bidding wars rather than the historic pattern of seasonal sprints. With greater normalcy expected to return to residential real estate markets in 2022, many experts believe that with seasonality will return as well. Buyers are likely to witness improving inventory with the onset of a more classic seasonal home buying. 5. Desire for shorter commutes again. As the pandemic made homeowners reconsider the cramped space in the downtown of the major metropolitan cities, folks retreated to the suburbs and beyond. Some buyers looked to communities near the downtown areas, while others gladly purchased in the further commute communities. more homebuyers were sizing up for homes' office spaces, outdoor space, showing an increasing desire for a pool, garden, or just more space to enjoy the outdoors. But as the world continues its path for normalcy and offices fill back up again, scores of buyers aim to strike compromises between proximity to the city and property space. For some, that will mean a renewed search for more spacious condos in the downtown areas, while for others, that will mean targeting suburbs with short commutes. At the end, people should forget about real estate crash that happened in 2008 and focus on what's happening now in the market. A market where big investors are taking over the big cities, which left the ordinary buyers with almost nothing to purchase. How to get your offer accepted in a seller's market. In the seller's market, to get your offer accepted on your dream home, you need to follow these 5 steps. 1. Make your offer as clean as possible. 2. Have a strong bank pre-approval and a big earnest money. 3. Offer above asking price. 4. Make a large down payment. 5. Include an escalation clause. 1. Make your offer as clean as possible. A clean, no contingency offer means that you're waiving all contingencies in order to make your bid a bit more competitive and appealing to the seller. A clean offer should not be contingent on the sale of another property or have other financial constraints. It should also be free of seller concessions, which are things that a buyer asks for outside of the offer price, such as help with the closing cost. When a seller is receiving a ton of bids, choosing to make a clean offer can help you beat out other offers with contingencies. The traditional contingencies are like a deck of cards you hold to your chest for protection. Loan, appraisal, and inspection are the main ones. As you lay them on the table, you give them up, which means your offer more appealing to a seller because you have less opportunity to back out of a contract that you write. Even if you don't add contingencies to your offer, there are still ways to protect your interests. For example, you can get your loan fully underwritten. That means that you will complete the entire loan process with your lender before making an offer on a home. Then, when you put an offer in, you can confidently put down your loan contingency with little to no risk. Giving up your inspection contingency. If the seller has provided inspection reports from reputable companies, then you can do this with little risk involved. 2. Have a strong pre-approval and big earnest money. If you're getting a loan for the purchase of your home, talk with a lender to get pre-approved for a mortgage. Then include a copy of your pre-approval with your offer. This pre-approval letter shows the seller that you're serious and further down the home buying process than someone who isn't pre-approved. While it's not a loan commitment, it shows a bank or mortgage company has preliminarily reviewed your credit and believes you will qualify for a loan up to a certain amount, which will be stated in the letter. All of this helps the seller feel more confident in your intent and financial ability to actually buy their home. Offering 1% to 2% in earnest money is the common practice today. However, if you want to let a seller know that you're serious, you can offer more money to convey this. Remember, this money is potentially at risk if the deal falls through, so make sure you're confident in the home and that you and your offer. You should also have the contingencies in place to cover you if in case you decide to back out later so that you don't lose all of your money. 3. Offer above the asking price. The seller's market is not the place for making low offers and hoping someone will bite. You will have to make your offer strong enough to beat out multiple bid situation. If you want the house, you're likely going to have to go above the asking price. Don't allow the thought of offering over the asking price overwhelm you. Sometimes you only need to offer $2,000 to $3,000 more to get the seller's attention. Doing this will show the seller that you're serious about buying the home and that you will want them to consider you as a potential buyer. Making an offer above the asking price won't end up costing you much in the long run. What you put down and what you pay monthly on your mortgage will only change significantly if you offer an amount far above asking. Keeping your offer aligned to the home's value, while still above the asking price, will help you secure the home you're interested in. 4. Make a larger down payment in your loan. No matter what type of loan you choose, offering to pay more down is another sign of good faith to your seller. Anytime you can showcase that you're in a good financial position, you should do so. By putting down a larger down payment than you have to, you send the message that you're serious about the purchase and capable of meeting all financial obligations. 5. Include an escalation clause. An escalation clause can be very useful in a multiple offer situation. With this clause, you state that if another person bids higher than you, then your bid will automatically go up as well. An example of this could be that you will offer $500 more than any other bidder up until a certain amount. The risk of this clause is that it shows the seller the maximum amount you're willing to offer for the house, so don't put more than you would want to pay. Thank you for watching, and remember that this is neither a financial nor legal advice. It is only for your education purpose. To refinance or not to refinance? That's the question. In this video, we're going to learn about 1. What is a home refinance? 2. The rate and the terms of home refinance. 3. The cash-out refinance. 4. The cost of a home refinance. 5. The no-cost home refinance. 1. What is a home refinance? When you refinance your mortgage, your bank or lender pays off your old mortgage with the new one. This is the reason for the term refinancing. Most borrowers choose to refinance so they can lower their interest and shorten their payment term, or to take advantage of turning some of the equity they have earned on their home into cash. There are 2 types of refinance: the rate and the terms refinance, and the cash-out refinance. Number 2. Rate and term refinance. In a rate and term refinance, you would typically be getting a new mortgage with a smaller interest rate, as well as a possibly shorter payment term, 30-year changed to 15-year term. With the recent record low interest rates, refinancing your 30-year mortgage into a 15-year mortgage may end up getting you similar monthly payments as your original loan. This is because of the lower amount of interest you would be paying on your new mortgage, even though 15-year mortgage payments are usually higher than the 30-year loans. The Truth About Mortgage states that it's important to be sure you find your break-even point before deciding to refinance your current mortgage rate. This is essentially when the refinancing costs are recouped via the lower monthly mortgage payment. Number 3. Cash-out refinance. In a cash-out refinance, you can refinance up to 80% of your current value of your home for cash. Thus, why it is called a cash-out refinance. So, say your home is valued at $100,000 and you owe $60,000 on your loan. Your bank or lender can give you, as a qualified borrower, $20,000 in cash out, making your new mortgage to be $80,000. In a cash-out refinance, you are not always saving money by refinancing, but instead getting a form of lower interest loan on some needed cash. Reasons for taking out a cash-out refinance could be that you may want to dig a new pool for your backyard retreat, or go on your dream vacation. Be aware, with taking out a cash-out mortgage, there is an increase in the amount of your lien. This could mean larger and/or longer-term payments. Remember that this is not free money and that you must pay it back to your lender. Deciding to refinance your mortgage is not something to be taken lightly. Always consider the cost of the refinance versus the savings in return. Talk to a financial planner if you are worried about whether or not to refinance, along with other options available to you.